that really, because you don't need, you don't have any questions on consolidations in the F3 paper later on. And even in the case study, you may not have. You are not going to have it. But here, at this stage, you are basically tested to the ultimate on consolidation. Unlike in ACCA, they test you consolidation even at the final stages.
That's fine. We're carrying on. If you want, we can have 2-3 sessions on this.
Because the consolidation is very important. So you remember what
whatever you feel.
Yeah.
Whatever you feel I need to spend more time on.
Okay, sure. Don't worry. Yeah. But what I suggest is you have to open up your F2 pass cards. Even maybe if you have time, good to go to even F2 study text on the consolidation area. Big area, but at least, you know, what I teach you, you will be able to absorb it if you read it maybe after our lessons.
F2, let me just see what email that you sent me in the beginning.
F2 pass cards. And also F2 study text. If you don't have, tell me, I will send you the study text also. Okay?
Yes, that's fine. If you can send them to me, pass cards and study text, probably best idea.
Yeah.
Because I don't did any of you, so I've got loads of emails from you, but
okay, right. So I will send it to maybe tomorrow morning. I will send it to you, and I would like you to go to that one. So you remember what we were talking about on the consolidation? We said a parent becomes a parent when you have a subsidiary, and that becomes a subsidiary only when you have power to control. Power to control. And generally it is assumed if you have 50% of voting rights in the other company, in the subsidiary, you have the power to control. The power is defined, the ability for you to make operating and financial decisions, and also you are exposed to variable returns. You are not entitled for a fixed return, you are exposed to a variable return. The dividends can vary from 1 year to the other year. And what we realized was when we buy a company or when we acquire a subsidiary, we may acquire the 100% of shares. In that case, we call it a fully owned subsidiary. Or we may take more than 50%, anything up to 100%. Then, say if you are taking 80%, the 20% is what we call outsiders. They are called non-controlling interest. Right? So that is what we learned earlier. So non-controlling interest. Right.
Yep.
Okay. So that's what we learned it. So there can be fully owned subsidiaries. There can be partially owned subsidiaries where we have outside interest, what is called non-controlling interest. So whenever we have a parent and a subsidiary relationship, the parent company, in addition to its own financial statements, must prepare what we call group statements, or what we call consolidated statements, consolidating the parent and the subsidiary, merging both the statements together. How we do is what we call acquisition accounting. And what is meant by acquisition accounting is the assets of the parent and the subsidiary added up, the liabilities of the parent and the subsidiaries added up to prepare the so-called consolidated statements. Right. Similarly, when you are preparing the profit and loss statement, again, the revenue of the parent and the subsidiary added up, all that is added up, except I told you one thing which is not added up. What is that? That is the subsidiary share capital is never added up. Only the parent company share capital is shown in the consolidated balance sheet, never the subsidiary. All the other figures, assets, liabilities are added up, but the reserves, we have a separate treatment. I'll come to that in a minute. The subsidiary reserves. So subsidiary assets are added up, subsidiary liabilities are added up, but subsidiary share capital is never added up. Subsidiary reserves we will look at in a moment, because we have to split between post-acquisition and pre-acquisition.
Yep.
Right. So probably it must be coming into your head some of the things what you have learned long time back as you go along with this one. And then what we said was, whenever we acquire a company, what do we acquire? We acquire assets minus liabilities. And that is what we call net assets. Net assets. Net assets of the subsidiary. Assets minus liability means the share capital plus reserves of the subsidiary. When you say assets minus liability, that is net assets. Net assets are equivalent to share capital plus the reserves of the subsidiary. So that is what we are buying. Whenever we say we are buying, we buy the share capital plus the reserves on the date of acquisition. Say today, 1st of January, if you are buying a company, and if that company has, shall we say, share capital of let's assume the share capital of a subsidiary, that what you want to buy today, 1/1/2017.
Yep.
Give me a minute. Yeah. So let's assume the share capital of the subsidiary what you want to buy is 100 million on today, 1/1/17. And let's assume they have reserves. What are the reserves normally a company has? Retained earnings and any revaluation reserves. Right. So let's assume those retained earnings and revaluation reserves . $100 million. 100 million is the share capital. Retained earnings are 70 million. Revaluation reserve is 30 million. This is what we have on the subsidiary today, 1/1/2017.
What's this RE reserve?
Retained earnings. Second one, revaluation reserve. Retained earnings, revaluation reserve.
Yeah.
This is what is appearing on the balance sheet or the statement of financial position of the subsidiary on this day, 1/1/17. What is the value? 200 million. This is represented in another way. This is represented by total assets minus total liabilities. So total assets minus total liabilities is equivalent to net assets. Net assets is equivalent to share capital plus reserves. So this 200 million is your net assets of the company. So if you are buying the entire 100% of this company, the value of this company at the moment as per books is 200 million. But as I told you, you will not be able to buy it for 200 million. You may have to pay more than 200 million. So that is what we call the consideration. So the consideration can be 250 million, for example. Why are we paying 250 million when the company has assets worth only 200 million, or when the company has net assets worth 200 million? Because there is something called intangible, things like reputation, things like the brand name, things like the customer loyalty, all that what we call goodwill. All that what we call goodwill. So 250 we pay for a company that is worth 200 million in the books, and that 50 million is what we call goodwill. That is provided if you buy a fully the 100% of this company.
But can we just quickly, briefly, can you brief me a little about this revaluation, reserve, retained earnings, share capital, just a bit of these. I mean, where do they stand in the company?
Share capital is what the company, the shareholders have put money. That's what we call the share capital.
That's quite understandable, to be honest, actually. The other
retained earnings is when a company makes profit, they don't declare all the profit as dividends. They keep certain amount of profits for reinvestment purposes, and the balance, whatever that is earned and not distributed as dividend, is what we call retained earnings.
I see.
Revaluation reserve is you buy a property today for 20 million or 40 million, and after 2-3 years the value has gone up to 70 million. So you revalue the property and make the book value 70 million, and the excess over what you have purchased or the cost is called a revaluation reserve.
The amount you paid initially is the revaluation value, or the amount that is changed?
Initially what you pay is always the cost.
Yes.
And then according to IAS 16, you can revalue the assets. Because you say your property what you bought 15 years back for 40 million is no longer 40 million. It has gone up in price. So you want to bring the real value, real prices in the books. So what you might do is you will increase the value, you will revalue, you will get a professional valuer to value your property, and the valuer will say, hey, it's not 40 million, now it's 70 million. So what you do is you increase the value of the asset to 70 million, and that increase from 40 to 70, 30 million is reflected as a revaluation reserve. So that belongs ultimately to the shareholders, because any gain belongs to the shareholder. So all this share capital belongs to the shareholders, retained earnings belongs to the shareholders, revaluation reserve belongs to the shareholders. All that together is what we call the net assets. That is what the company earns. That is what the company owns. The company's property, the company's value. This is what is measured by what we call the net assets. So, if another company wants to buy this company when it has a worth of 200 million in books, if they are going to pay 250 million, the other company, the parent company, has to pay 50 million extra, and that 50 million extra, why are they paying? Because they believe they have something more than 200 million, and that is what we call the goodwill.
So that's the share capital revaluation revenue and the retained
earnings all
together. That's all total assets, yeah?
Total assets. Not the total assets, the total net assets.
Net assets, yes.
Total net assets. Total net assets means assets minus liabilities. So when you have a value of, that is the value of the company.
Yes.
The value of the company. The value of the company means that is the value that belongs to the shareholders. Of your total assets minus liabilities is what belongs to the shareholders, and that's why we call it net assets. Right? So 200 million is the value of the company, and we are going to pay 250 million to buy this company, and that 50 million will be reflected in the consolidated balance sheet as a goodwill. Because you paid extra, right? You paid extra. You are acquiring 200 million worth of assets, paying 250 million. That 50 million is considered a goodwill. Now that is fair, straightforward. If you are buying a company 100%, where you are buying it, it's a fully owned subsidiary. But not necessarily all the time that you will buy a fully owned subsidiary. You might buy a company only 80%. 80%, right? So then what happens is you are paying a consideration. Shall we assume the same consideration we are paying? How much is the consideration we are paying? 250 million. Right? But what we are buying is not the entire 200 million. We are buying 80% of 200 million.
Mm-hmm.
Because we are now not taking the 100% control, we are taking only 80% of the control.
Oh,
Okay?
okay.
So 80% of 200 is the value of net assets that your parent company will own.
Mm.
Right? So of 80% of 200 is 160.
Mm.
In that case, you can see the goodwill what you are paying will be 250 minus 160, 90.
Mm.
When you take out of 200 million worth 80% control, the balance 20% is owned by whom? It is owned by so-called non-controlling interest.
Mm. But do we still have to pay the full goodwill?
It all depends. It all depends on the figures because it is finally, ultimately, it's a negotiation that happens. You may,
I was gonna say. Mm.
yeah, you may be paying, you may not be paying 250, you may pay 190, but maybe. But what I discussed was just taking the same consideration. I want to show you when we acquire a full control, we pay less to the goodwill. When we acquire a smaller control, we have to pay, if you have to pay the same consideration, a bigger amount to the goodwill.
Mm.
It all depends on the negotiation. You may not pay 250 when you are buying 80%, you might pay only 200 million. You never know.
Mm.
It's a negotiation. But the principle involved is whatever the consideration you pay, if it is full net assets, deduct the full net assets, then you get the goodwill. But if it is proportion of net assets, deduct the proportion of net assets, then you get the goodwill.
Mm.
Now in this second scenario, after 200 million, we bought 80%. 20% is with outsiders, and that is 20% of 200, which we call non-controlling interest, and we will show it as 40 million.
Mm.
Right? So this is something which we need to know. Now, so basically the consolidation, we will have to learn it a lot, because I think out of the 700 pages in the study text, it's about 400 pages on the consolidation. So we will learn as relevant as much as possible for the case study, whatever that is required. Now,
yes.
As I told you, sometimes when a company is being taken over, now remember, to take over company means to acquire a controlling interest, it need to be more than 50%. If you don't have a 50%, you are not controlling.
Mm.
Now, sometimes you might not take over the entire control today. That same company I'm talking about, 200 million is net assets. Today on 1/1/17, you might take over only 30%. 30% you are taking. The parent company is taking 30% control. And if I use the term control, that is wrong, because at 30% you can't control. You only have what I call, you remember, significant influence.
Mm.
Significant influence. So with 30% today, 1/1/17, it becomes your associate company, but it never becomes your subsidiary. Right? But maybe 6 months later, somewhere around about June 2017, you might take another 25%.
On the parent company.
Parent company will buy in the subsidiary another 25%. Originally it was associate. X. Originally it will be an associate company. 200 million is the net assets. The parent company P, in that case it will never become the parent also because still it's an associate, but the P will have a 30% interest and in X, and X will be an associate company on 1st January 2017. So you will not consolidate because you can't consolidate because the X is not a subsidiary yet, right? But on 30th of June 2017, you buy further 25% shares of that company. So this is what we call piecemeal acquisition. Piecemeal, in installments, in pieces we take it. The moment you take 25%, you have 55%. At this point, the X becomes a subsidiary. It was never a subsidiary on 1st January 2017, but the moment you take the second installment, it became a subsidiary. Now,
before it was associate.
Before it was an associate, because you remember I told you, if you hold 1 to 20,
investment.
It is just investment. 20 to 50, associate. Anything over 50, subsidiary. So if you hold just 30%, it's not a parent, it's not a associate, it's a subsidiary. Sorry, it's an associate. But the moment you take the next 25%, on that day, 30th of June 2017, it becomes a subsidiary. So remember, the goodwill arises, I want you to note down this one very carefully, goodwill arises only with a subsidiary, not with an associate company. Goodwill arises only when it becomes a subsidiary. So when you pay on the 1st January, maybe the assets were 200 million net assets, and maybe you have paid 80 million.
No goodwill with associate or
no goodwill with associate. No goodwill with associate. So 200 million is the worth of the company. Maybe you acquire 30% for paying 80 million. You will never work out a goodwill. Right? You will never work out a goodwill. Now, so it will remain as an investment in associate company, 80 million. It will be shown in the parent, in the P company books as an investment in associate, 80 million. And it will never be consolidated, no goodwill, nothing at all. But the moment you buy that second 25% shares, it becomes a subsidiary. At that point, you have to work out the goodwill. So how do we work out the goodwill at that time? So say on the 1st of January, the worth of the company P is 200 million. Now by 30th of June, the company's worth, the company X worth would have gone up from 200 because they would have made some profit during the 6 months, and maybe it had gone up to 220. Right? So on 1st January it was 200, now it is 220. So 220 is the value. So you have taken 55% control of this company. So 55% of 220 works out to how much? 220, 55%, that is the value that you are going to take over. So it comes to about 121. 55% of 220. Now what is 220? That is the net assets on the day that you became a parent. Not on 1st January 2017. On the day that you became a parent, the value of your company, the subsidiary now, it is 220. So 55% of that is 121.
So
Now,
when you buy 20, when you buy the 25% of the company, the
yeah.
second one, though first 30%, so you buy 30% of 200 million, which is, I don't know, 60 million. But when you buy that 25% of the value in June, 25% of the share value, then you're buying 25% of 220?
No,
Correct me if I'm...
no. Now what happens is, originally you had a 30%, but that 30% does not entitle you to control the company. But the moment you buy the second 25%, you are entitled to control the company. So now you are not going to look at 2 installments. You are going to look at 55% on the day of the control.
No, what I'm saying is, when you bought the 30%, you bought the 30% of the 200 million. So you must have paid 60 million.
No, you always pay more than the amount. No, I told you 200 million, 30% is 60 million, but you will pay something more than that. But that more than that, what you have paid is 80 million, but you are not going to call that a goodwill.
Oh, you're paying anyway, but you okay. I thought there is no goodwill associated.
No, whether there is no. For calculation purposes, there is no goodwill. That is for consolidation, but you have to pay more. When you are going to take a 30% interest, they are not going to give it to you at 200 million, 30%, 60 million. They will say the value is, the value what is appearing in the books for motor vehicles is not the same value and all that. We have to revalue all that, and they will ask for a higher figure. Always. Unless it's a loss-making company, it's not because you are paying something extra, not because you are going to take a control. You are paying something extra because that company has something called a reputation and something.
Yeah.
But we don't work out a goodwill. But we don't work out a goodwill when it is 30%.
Okay.
There is a goodwill. But according to IFRS 10, we don't work out a goodwill when it is 30%.
I'm with you.
Right. When it is 55%, we have to work out a goodwill according to the IFRS 10. Whether IFRS 10 is there or not, it's a different story. We have to pay extra because the other company doesn't care about IFRS 10. The other company will say, the company X will say, look here, we have a reputation. We want more. But for accounting terminology, for accounting standard purposes, when we take 30%, we don't show 80 million is the consideration, 60 million is the value of assets, and we don't show 20 million as a goodwill. Understand? Right? But the moment we go up to the 55%, the goodwill pops up because you are controlling. At that time, you must show the goodwill. So now how do we calculate the goodwill? So as I said, now on the day that you took the control, not on 1st January 2017, but the day that you took control, 30th of June 2017, the value of the company is 220, not 200, 220. So we are taking 55%. What is the value of 55%? 121. Now, you have to be very careful. This 80 million you paid on that particular day, 1st of January 2017, now on 30th of June 2017, that 80 million also would have gone up in value because the company has made profits, right? So the fair value of this 80 million, the examiner might say, originally you paid on 1st of January 2017, 80 million, but now the fair value means the market value of that on 30th of June 2017, they might say it is 85 million. Right? 85 million. So original 30%, what you bought for 80 is worth 85. And now you have bought another 20%, 25%.
Yep.
Right? You have bought another 25%. Let's assume that 25% you paid another shall we say for the 25% you paid 70 million money.
Mm.
What is the total consideration to acquire the control? Original investment, which was 80, is now worth 85, and the balance 25% cost you 70. The total consideration is 155.
Mhm.
This is the very important one. This is what we need in the case study. Whenever there's a piecemeal acquisition, right? At the very beginning, no control. At the second stage, we got the control. When we got the control, we had to find out the net assets on the day of our share. 120, 55% is 121. Then we have to see the consideration, what we are paying. Consideration is made up of two installments. First one, what we paid at the beginning, but not what we paid at the beginning. What is the value of that as at 30th of June 2017?
Market value of this,
Yeah, that is what normally we call fair value. Fair value of that
yes.
original investment. Plus,
Yeah.
how much did we pay for the balance 25%? 70 million.
Mm.
So altogether we have paid 155. Right? And the value of the assets is 121. So at this point, we will record the goodwill at 34. And this is very important because this is where you will be tested in your case study most of the time. It is all about the goodwill. Either we buy on a piecemeal basis or you sell on a piecemeal basis. Maybe
what's it called?
Piecemeal. P-I-E-C-E-M-E-A-L. Piecemeal.
Okay, piecemeal.
Piecemeal. That is without buying it in one shot, you buy it in 2 shots or 3 shots, or you might sell it not in 1 shot, in 2 shots or 3 shots. So this is the principle that we need to work very hard, and the mark that what I gave you was about a subsidiary being disposed. So we have to look at those areas, but we have to go through this acquisition very carefully.
It's quite interesting, yeah.
We have to go through these acquisitions very carefully to find out the finer principles, because we don't need to do calculations, but we need to know the methods, how to work through, and the approaches to do it. Because the moment we have the 30%, it's not a subsidiary, no goodwill. But the moment we take the second 25%, it becomes a subsidiary and there's a goodwill. And to calculate the goodwill, we don't take the original cost, we take the fair value of that amount at that particular time when we got the control. That's the point where we will have the goodwill arising. And this goodwill, 34 million, will be tested for impairment thereafter every year. And if there is any reduction in the goodwill, we will write it off. If there's an increase in the goodwill, we will ignore it. Right? So this is what I need to go on and do with you before I can move into the real consolidation part of it. We had to fix up some classes, I think, for the week. How is your calendar?
Yes. Wednesday, I'm working tomorrow and the day after. Wednesday is a good day for me.
Okay, Wednesday, yes, I'm all right. 4th, yes. What time is convenient for you?
Anytime really. I'm free Wednesday, full day.
Full day?
You're convenient.
So shall we make it on about 4:30 Wednesday evening?
Yeah. Yes, it's fine.
4:30 Wednesday. Right.
Then Friday, Saturday, Thursday I can do as well actually. Thursday, Wednesday, Thursday.
Wednesday and Thursday. Yeah, so Wednesday and Thursday, shall we keep it 4:30 both days?
Thursday we can do late 6.
6 can do. Yeah, can do 6, yes. Okay, no problem. So we'll keep this Wednesday and Thursday for the moment.
Yes.
And we will see how it goes off.
Yes, if you can send me the past cards and
the
study text.
We will send you the past cards and the study text. Go through the past cards. The study text is too big, but go through the past cards. You might be able to get something out of it.
Brilliant.
Okay, have a great day.
Thanks, Kumar.
Thank you. Take care. Bye.
Bye-bye.
Bye.